All right, guys, welcome back to We Talk Money. Man, so much to cover today. Everybody is talking about what'd you call it? Sell everything and go to the beach?
Yeah. Buy bonds and go to the beach, baby.
Yeah, why would we do that? What is the thinking there? What's the big narrative now, and where's everybody's heads at?
Yeah. So we saw over the past couple of weeks that government bond yields have risen quite a bit, actually. And so when you look at even shorter term bonds, like the 2-year yield is up to like 4.7%, basically nearing its cycle highs again. And you've got 6-month bills yielding 5%. Everyone expects the Fed to keep on an aggressive path now. And that means that bond yields at nearly 5% are a pretty good return for your cash, while stocks still a little bit expensive and earnings are in decline, don't look nearly as good on a relative basis. And so why wouldn't you just park some money in bonds and go to the beach and stop worrying about all the equity market volatility?
Yeah, so taking a look at the chart real quick, 6-month bonds up above 5%. And Nikki, I think you were tweeting about this. Let's see if I can find it. You said, get paid 4% or more on cash, or sit in a potentially flat slash choppy market for a while. That's the question, right? So yeah, if stocks are going to underperform for the next several years or chop around, or if there is a high likelihood of a recession, why wouldn't people put more money into bonds and not take the added risk? And also we'll talk about what that means for Bitcoin. But what do you want to add to that, Nick?
Yeah, I think that something to add to that someone commented on that I thought was an interesting point was that a lot of retirees, they've kind of been, or not retirees, but retirees and future retirees that are close to retirement, they've been kind of forced to have an equity position or a larger equity position than they maybe would have in a normal interest rate environment. But since we've had low rates for so long, a lot of baby boomers have had a larger allocation to stocks than they probably wanted to. So now this is going to give a lot of optionality to boomers and people that are close to retirement or in retirement. And that's something to think about. Like, what does that look like in terms of that money, that capital shifting around as people start to realize, oh, I can lock in, 2 years plus 5% or as rates keep going up, who knows, exactly where that will land, but it's going to look attractive for people that can't afford to take on risk right now, especially in a high inflation environment, especially retirees. So it's like a lot of equities that could end up being, and Tracy was someone that responded to me on that tweet, so credit to her for this idea. But if boomers start to sell more equities to get into more bonds and reallocate, that's going to be an interesting dynamic for the market.
Yeah, and I think the big question is, do you see further inflation as the big risk or recession as the big risk? And that will tell you what you should do here or guide you at least somewhat. And it's not like I'm personally going out and completely changing the total composition of my portfolio. Like, I'm still going to own some stocks that I think are good bargains, and I'm still going to hunt for stocks, especially if the market corrects. But it's undeniable that for my cash and for some of my riskier positions that maybe I should be shifting into bonds. I'm of the camp that says that I think we're getting closer to a peak in inflation, at least short term. And I think this concern about the Fed having to go to 6% or higher is overdone. I think we're actually getting probably a little bit closer to the time frame where I think people are going to start worrying about recession. Why do I think that? Well, one thing that we saw today, ZipRecruiter reported their earnings, and the company is essentially a big online site for companies to post jobs and job seekers to find jobs. And ZipRecruiter came out and said that they saw revenues down 15% in January, and that they're seeing significant weakness in hiring trends from small and medium businesses, particularly in technology and finance. Some of that weakness offset perhaps by some strength in retail and healthcare jobs. But overall, they're seeing the hiring trends turn down here at the beginning of the year. And that runs a little bit counter to what we've seen in the previous unemployment reports, which showed that, the job market's still very strong. But I think as we go further into the year, we are going to see the impacts of all these tech layoffs. We are going to see the impacts of businesses pulling back on spend in certain areas. And so I think it's not really evident right now, but outside of the manufacturing sector, at least. But I do think that we're going to start to see some concerns about economic slowdown, at least in the US, come summertime. And so I think the Fed will be put on pause at 5% or maybe slightly higher. And I also think that the shelter component of inflation will start to get some relief as we get into early summer. So I think within 3 to 6 months, we're going to be a lot more worried about the probabilities of recession than we are about inflation spiking up again. But that's my personal opinion.
Yeah, just taking a look at the interest rate probabilities going out through the rest of the year. It looks like right now everybody's looking for 5.25 to 5.5. Any thoughts or opinions on where that could get to? Is that overshot, undershot?
Yeah, that feels right for now, but I do think that we have seen the probabilities increase for some of the higher reaches of those rates. Like, so if you look at the 550 to 575 or even the 6% range, those were at very, very, very low probabilities just a couple of weeks ago. They're not the majority of probability, but they have ticked up. Like that 550 to 575 range of Fed funds rates is now up to like a 25% probability by July. I just don't think we get there. So the market is starting to worry a little bit more about the Fed having to stay aggressive, given the CPI didn't come in as low as some people expected last week. But again, I think within 2 to 3 months, we start to get a little bit of relief from that shelter component of the CPI, which is a lagged figure. And I think it will become more evident that there are parts of the economy that are weakening. So yeah, I think it feels about right where the middle of the probability curve sits today. And I would expect the Fed not to go 50 basis points at the next meeting, like some people are concerned about. But we do have one more CPI report and one more jobs report before that Fed meeting in late March. So there's a lot that can happen as far as those probabilities and how they can shift before the next meeting. So there's still a lot of data to be seen.
So basically the two ends of the spectrum are recession, where equities break the lows, or inflation, where rates go up. And that's not necessarily bullish for the stock market either, is it?
No, probably not.
So what is the bull case for the equities markets right now?
That we thread the needle into that soft landing. And that's
earnings
tough.
not being as bad as expected, maybe, but like now, yeah, I guess narratives are starting to shift again. It's just felt like a constant shift in narrative over the past, 6 to 12 months, and more recently, it's just starting to get mind-boggling with processing it all. But yeah, now people, a few weeks ago, people were optimistic on the economy, optimistic that we were going to have a soft or no landing. And now people are starting to talk, unemployment spiking again, recession fears around just the market in general and what the Fed is doing that's going to crash the economy. And so the narratives just keep shifting. And I mean, the risks are there, obviously. And Chris, I ended up tweeting about this today, where I was at first thinking, well, the unemployment rate is so low that maybe we can pull this off because we're coming from such a low rate that even if it does spike, it won't spike that much. But historically, what has happened is when the Fed pivots and starts to decrease interest rates again, for the most part, maybe not every single time, but generally speaking, that's when unemployment spikes. So we've seen back in 1969, we saw a similar unemployment rate being so low. And so initially I was like, well, maybe, that'll save us. But no, it didn't save them back then. And my question was like, what's different today versus what happened then, right? So I guess the big question, at least on my mind, is, and maybe you guys know, maybe you don't, but what is going on in today's environment, macro environment and economy that's different from what has happened historically that that this time could be different, right? That's like my big question. And I don't know if I have that answer yet, but it's definitely something that I've been noodling on as I try to parse out what's going to happen. But based on history, the unemployment rate is going to spike when the Fed starts to pivot.
So basically right now we are at historical lows of unemployment. Rates are going up. And so your thought is when the rates start to roll over and come down again, that's when unemployment could spike. And then I guess the second part of that is there something different that could cause another outcome
right,
other than what's historically happened? Trav, what do you think?
Yeah, typically that unemployment spike will lead the pivot a little bit because the Fed pivot is usually in response to a weakening labor market and a weakening economy. So that's why I'm so focused even on like weekly unemployment claims here in the US, just to keep a very sharp eye on what's happening in the labor market overall. And again, I think it's TBD to some extent. And I think it's also a question of magnitude because are we going to get an unemployment rate that ticks up to 4.5%, or will it be 6.5%? The impact on the economy is very different at those levels. So I would expect that we're going to get some uptick in unemployment, especially if the Fed remains on an aggressive rate hike path. The obvious reason is that that hurts businesses' cost of capital. It disincentivizes business and capital spending. And eventually it causes companies to cut back on employee headcount and expenses. And I think we've had some structural reasons why businesses have been slow to cut employees. You know, they just came out of a pandemic where they were having a hard time finding labor at a reasonable price. And we had to raise wages and businesses were hiring a lot and finding it difficult to fill open positions. But now that's starting to shift. And so I do think that lagged unemployment increase will finally happen at some point later in the year. But it's just very difficult to see everything in real time and be able to figure out exactly where the end state is. You know, we can see directionally where things go in real time, but it's hard to figure out, well, are we going to end up with unemployment at, 6, 7, 8, 9%, or is it just going to tick up to like 4.5% and we might hit that soft landing? Yeah, I think, the Fed is going to play a big role in that. Obviously, that's why we're so focused on them. And, I think they've been fairly data dependent in the last 6 months. So I do think they will pause/pivot at some point when the unemployment rate does tick up, but we still might be a couple months away from that. So that's kind of how I see things.
Well said. Yeah. For me, the macro side of things is so hard to predict. And a lot of times I like to let price action be a guide, right? It's like we can come up with these ideas of what the macro picture could look like. But at the end of the day, there's so many variables, right? And I don't know. Do you guys agree with that or disagree? Like it's really hard to predict what the market outcome is going to be just on the macro picture.
Yeah. And what's also weird about it is that sometimes what happens in the market will dictate what happens to the macro. There's like a feedback
Mm,
loop that happens between the
Yeah.
two. So, as we saw with the market rallying last week, we were on the podcast talking about how stocks weren't reacting to the rise in interest rates. And then, of course, over the next week, stocks did start to weaken. Energy prices have weakened. Bitcoin kind of topped out a little bit. And so, now the narrative completely shifted in just a week about what
That's what
people
I'm
are
saying.
expecting.
That's what I'm
And rates go up and they kill the housing market, right? So you can go from being like, hey, maybe we're in a soft landing and the housing market's recovering. And all of a sudden, 2 weeks later, rates are up and the housing market is weakening again. So the markets have this feedback loop with the actual economy that makes it even more difficult to figure out what's going to happen.
yeah.
So
Before we look at the charts, let's actually talk about housing because this is actually looking really weak. So this was earlier this week. We had existing home sales that came out, and they are basically below early 2020. If you guys remember in like March, April, when everything went on lockdown, the real estate market essentially shut down. And then by the second half of the year, it was absolutely on fire because everybody wanted to get out of cities and they wanted more space, right? So for you guys that are listening to the audio podcast, which you can subscribe to on any of your favorite podcast platforms, you can see existing home sales is back to basically where not quite the depths of the global financial crisis in '08, but it's pretty damn low. And interest rates on mortgages are actually starting to climb back up. Let me see if I can pull this up. Yeah, so they're back up about 6.5%. So I don't know. I mean, I've sent out a kind of a bait tweet this week where I said, hey, I think this could be a good time if you're a cash buyer. And I just got flooded with people that were like, oh yeah, but no, prices are still way too high and there's still a supply shortage, which I agree. There's definitely supply constraints. There's supply problems in the real estate market, but there's also, from what I'm hearing is the brakes have just been slammed on new and existing deals because people don't want to pay these prices, right? And people that are willing to do it are basically hoping for rates to come back down so they can refinance, which we talked about last week. But how do you guys see this playing out in the real estate market?
I feel like we were better off almost with going 100K over asking at 3% than you know what I mean? It's like that's kind of a crazy thing to say, but when you do the math, it's like your mortgage payment was much lower. So these interest rates really are killing people's ability to afford a home. And so I think that I know certain markets have collapsed in terms of housing values more than others, but I'm not really seeing how housing prices don't continue to come down. I mean, I guess the only thing kind of helping that is the low supply, because I just popped up the housing U.S. existing home inventory on Y charts, and yeah, it's just been in this decline since 2007. So we haven't really seen that uptick significantly. So there is a supply issue, and the problem I see is if housing prices don't budge more while rates continue to climb because of the supply issue, that to me is a huge, huge, huge affordability problem. So something's got to give somewhere, and that's eventually probably going to happen. It's just a matter of like when and how, and maybe it won't come in. Maybe prices won't come in as much as buyers really need them to. That's my concern.
Mm-hmm. Yeah, I don't know. I've been thinking a lot about it, but it's just one of those things that I think is kind of hard to predict. Let's take a look at some charts, because we can talk about data and stuff all day long, but to me, price is truth. And right now, I think the market's at a really, really pivotal level. If we take a look at the NASDAQ, which I think is probably just a really important place to look at for both investors in obviously stocks, but also crypto, because crypto prices, especially Bitcoin, has just been tracking the NASDAQ basically since the high here, right? So basically throughout 2020 and 2021, the Fed created a ton of money, which went into stocks and crypto. And then here throughout the last year, we've been in a bear market for almost a year now. And we were making lower lows, lower highs. And then just over the last month, we actually broke above the 100 period and the 200 period moving average. We made a higher pivot high from mid-December. There was a pivot high here in the NASDAQ, made a higher pivot high. And now things are pulling back. To me, this is a do or die zone where if we pull back to retest the 100 period and 200 period moving average and we bounce and we take out 13K on the NASDAQ, to me, that's a really bullish sign. If that rolls over, and this could happen pretty quickly, this could happen in the span of like a day or two, where if we slam below these moving averages, I think we're heading for fresh lows, and I think it would pull Bitcoin with it. I just, this is one of those moments where it's the first potential change in the overall trend, but a lot of times, and we can go back to 2008 and even the tech bubble, where we kind of got some of these fake out trend shifts, and this is just a very dangerous, or I should say like important area on the charts. Is there anything you guys are looking at on the charts or kind of technically?
Yeah, I was watching that Bitcoin to NASDAQ ratio last week because it looked like Bitcoin might actually break out of the area that it's been in for the better part of the last couple of months. It looked like it was going to break above 2. In fact, I think it did break above 2 for a brief period of time, maybe 2 trading days or so. And so it looked like maybe there was a possibility that Bitcoin was decoupling from the NASDAQ. And I thought that was interesting to see that relative strength from Bitcoin, but it has faded back under that 2x ratio level. So yeah, that was, I guess, maybe just a fake out, or perhaps it's still has that potential to decouple, but it's going to depend obviously on a lot of these other macro factors we were just talking about, or not. Maybe Bitcoin decides to go its own direction at some point. That's kind of what we were hoping for to see. I know you were looking for that as well, but maybe a bit of a fake out last week on that front.
Yeah, any random day, where there's a little bit of a decoupling, I don't get too excited, because usually one or the other will play catch up. And so like yesterday, we had the big snap down on Tuesday, the 21st, where the NASDAQ was down over 2%. And, Bitcoin was down about 1.5%. But if you look at the chart, Bitcoin does look like it's been holding up better. But today kind of played catch up. And as of today, it's down like 2.5 to 3%. But overall, yeah, Bitcoin has been showing some relative strength. And that's really what I'm looking for, is like this 25K zone. If we can just break that and sustain above 25K, I think that would be a really bullish signal. And that's why for you guys watching the video, you can see alerts. What I like to do so I don't get tick locked or I don't get overly obsessed with the chart is I'll set alerts. And that way, if I'm out working out or driving or doing something where I'm not paying attention to the price action, if we start to challenge one of these areas, either a breakdown or a breakout, I'll get alerted to that. Obviously, I am watching the charts throughout the day quite a bit because I'm a nerd like that. But as far as like alts go, I've been really, really conservative with altcoins, just because even though we've been in kind of popcorn season where we have seen some alts that have done some pops, there's also just been a lot of traps. There's been a lot of fake out breakouts this week. There's been a lot of charts that were showing potential breakouts, but over the past couple of days, as Bitcoin's pulling back, alts run scared even more so quickly. So I've just been playing it really slow and really conservative. Another thing that I've been looking at is Bitcoin dominance, which this basically shows, how, of the total market cap of the crypto economy, what percentage is Bitcoin of that, right? And we saw, back in the early days prior to 2016, Bitcoin was basically 95 to 100% of the total crypto market cap. And then in each altcoin bull market, going back to 2017 and then here in 2021, we've seen Bitcoin get as low as 40 to 45% of the top of the total market cap value. And over the past year, you can see Bitcoin's been kind of stuck in between 40 to 50%. And it basically bottomed out where the markets topped out, right? So as altcoins topped out and rolled over, they fell on average a larger percentage than Bitcoin, right? A lot of alts fell 90, 95% or more, where Bitcoin was down about 75%, right? And so what I'm thinking is, if Bitcoin breaks out above 50% again, that's going to be a sign that people are rushing to, call it a flight to safety, at least in crypto, where Bitcoin people are piling into Bitcoin and altcoins are continuing their sell-off. Whereas if something happens that causes Bitcoin to convincingly get below 40% of total dominance, that to me would be a signal that we're back in some kind of massive altcoin run, or that one large cap, maybe Ethereum or something else, is really starting to gain value and is breaking out on the ETH BTC chart, right? So ETH BTC, which is just basically looking at the value of Ethereum compared to Bitcoin, has been flat and choppy really since that whole period. So you can see, there's been no kind of momentum here. They both kind of gone down together, right? But if ETH breaks out against Bitcoin, I think that could cause that Bitcoin dominance to snap. So I'm keeping a close eye there. I don't think we're going to get an altcoin season this year. That's just my guess. That's my opinion. Are we going to have some alts that break out and have trends? Yes. Are we going to have an all tides rising event? I don't think so. I think the fallout from FTX and just the whole negative market sentiment around crypto, I think is just too heavy right now for alts. And I still think there's a lot of alts that are overvalued. There's a lot of like just shitty projects or dead projects that still have market caps of hundreds of millions of dollars. And so I wouldn't be surprised to see Bitcoin market dominance go back up. The big question, though, is can it convincingly get back up above 50%? So that's kind of where my head is. I think that overall, I think it's going to be a mixed year. I don't see a full-on alt season, but what I'm looking for is 25K on Bitcoin. If that does break to the upside, maybe we get a quicker bull market ahead of the halving, which is still about 14 months away. So that's kind of what I'm thinking. I'm being conservative. I'm dollar cost averaging a little bit, but I still have a lot of dry powder in case we do get a worst case scenario where stocks end up dragging Bitcoin with it.
And that would line up pretty well if we had that. If we do have the economy weaken, and if we do see crypto prices weaken along with stocks, let's say mid to late summer into fall and probably winter timeframe as well, then you actually do get a Fed pivot, and maybe you start to get indications that they may be looking to reduce rates at some point, say early 2024. Then you set up really nicely ahead of that halving event just a couple months before, and then also you're coming into the bottom of that recessionary cycle potentially, hopefully, right? Hopefully it's a recession that's relatively short and shallow, and you do get that Fed pivot. So that would line up pretty nicely if we could get those types of low prices near the bottom of the cycle just before that halving cycle as well. That'd be a really nice timing, I think, for the crypto ecosystem.
Yeah. Well said.
Maybe not matching everyone else's preferred timing of Bitcoin going to the moon next week.
I mean, that's the thing. That's why, like, after an extended bear market, it usually takes a year or two for Bitcoin to churn that out, right? And during that year or two, kind of in that accumulation range, you get a lot of fake out breakouts. You get a lot of people that get overly excited. They get FOMO too quickly, and they just want to press the fast forward button, and that's where you get run over. So could this time be different and we reverse? Sure. But there's just right now, Bitcoin is trading differently than it did in the early days, right? In 2013 to 2017, it really had a mind of its own. And Trav, you even ran data back in the day and found that, yeah, it was trading inversely correlated to the S&P or just randomly, right? Where right now in this environment, it's trading very closely. And to ignore that, I think, is a big mistake.
Absolutely. Did you make anything of Coinbase's earnings yesterday? I think the stock's down about 4% today.
I'm not surprised to see them. What did they do? Underperform quite a bit?
So they beat expectations slightly around some of the metrics, but overall it was a pretty awful report from a financial perspective. Like adjusted EBITDA losses are still quite bad. You know, they're still seeing revenue declines in excess of, I think, 70% year over year. And retail trading volumes are down 90% plus. So they're still expecting to have losses this year, although they're trying to cut expenses rapidly and try to get to a point where they'll eventually break even. But at least in the current cycle with the current level of trading volumes, they're hurting pretty bad. And the stock's still trading at a $14 billion valuation. So there's a lot of optimism about the longer term future there still. I think they had some interesting comments too about the regulatory environment. They're clearly at odds with Gensler and the SEC, and they're going to put forth a very big lobbying effort in the next probably 2 years to try to get some crypto legislation passed that will help to alleviate their worst case fears. Like they don't want to have everything classified as a security, obviously, and they're doing their best to put dollars into lobbying in Washington to try to keep the legislation on the crypto side from being a worst case scenario. So TBD on what happens there, but you know, Coinbase probably is one of the bigger forces from a North American perspective in terms of pushing back on the regulatory overreach. So I hope to some extent they succeed, but it's very uncertain what happens from a business perspective and from a valuation perspective to Coinbase stock over the next 6 months. I think there's still a lot of downside risk potentially there short run.
Yeah, look, I think I'm more bearish than bullish on publicly traded crypto exchanges. Yeah, I mean, look, the trading volumes are way down, right? And with the regulatory pressure, I just don't see that easing up. I don't see us doing a 180 to where the SEC just all of a sudden stops the momentum that they have going with all this regulatory action. I mean, if I'm putting myself in Gensler's mind, I'm embarrassed that I missed all the big implosions, right? Three Arrows, Luna, FTX, right? They have to do something, like we said last week, to justify their existence. And I just don't see how, even with like fee compression, right, and competition, right, that's another headwind that Coinbase has going for it. I just don't see how they come back to where they were before, or like how you justify that valuation. I don't know. I want to, I just can't get there.
Yeah, I agree. You know, they were making over $1 billion of positive EBITDA a quarter at the peak. Eventually, I think they can get back to a profitable business. Exchanges, as we talked about, are super profitable businesses, but Coinbase is still facing a lot of headwinds, and especially when you're in a price cycle like we're in now, you've got a really tough road ahead to justify the type of valuation it has. So
Yeah.
I think that Coinbase is probably going to be more of like a trader than anything. Like people will be able to kind of get on the bandwagon and trade it during market cycles. Like when we break, if Bitcoin breaks out of that 25K zone, or whatever that zone is, then we may see a lift just based on that. Like it may just follow what Bitcoin does as from a trading perspective, but from an investment perspective, it's probably going to be a volatile investment and a rough go.
if
Yeah.
we get into a deeper stock market correction / recession, Coinbase stock could still have like 50% downside from current
Right.
Yeah.
levels.
Yeah. Let's list all the risk, right? Recessionary risk, fee compression from competitors.
That's huge.
Yep. With that kind of combined with the regulatory pressure where a lot of trading volume is leaving the US anyway, right? Yeah, I don't know. I guess the only practical thing that I can see that would be a positive turn for Coinbase would be if they started listing security tokens and all of a sudden we got like regulated assets trading on Coinbase where, you could, hey, did you buy your fractional ownership in this new Times Square building through Coinbase, stuff like that. But if security tokens are a slow burn or they don't really take off and the ICO, yeah, if the shitcoin market doesn't make a rebound, I mean, I don't know where they end up.
Yeah, eventually you'd hope that they'll get a recovery in trading volumes with the overall crypto cycle, and that would obviously benefit them tremendously.
Yeah.
But I'll give them credit as well. They've done a good job of increasing some of their institutional revenues and their subscription services, but that's still just a relatively small part of the business. So it's still going to take many years for that to further diversify the overall revenue base. And it's still heavily dependent on retail trading volumes. So they really need the cycle to recover in terms of trading volumes. But there's also the question of, are they going to be able to sustain the uptick in revenue from interest rates? They basically got a big uptick in revenue this past quarter from holding client balances and putting them into treasuries essentially and not paying their clients that interest. And at some point, people with balances sitting in Coinbase might say, well, I think I'd rather put my USDC or my cash in Coinbase into short-term bills or money market funds and actually earn that interest myself. And so I don't know how sustainable that is, but there were a couple of bright spots like that for Coinbase. And if the cycle turns back up, they're probably okay. But like you said, longer term, there's still concerns around the regulation side. Are they going to have things like staking cut off and that revenue goes away? Are they going to have too much fee compression from competitors and things like that? So it's really tough.
Didn't even mention that staking and DEXs, right? Like just add that to the competition list, right? Not just Binance and overseas exchanges, but yeah, decentralized exchanges are eating their lunch too.
Yeah, absolutely.
Let's talk about something really fun, which is
Taxes.
No. Let's talk about retirees and what people think they need as a nest egg. There was a company that was doing a lot of advertising on Instagram. I kept seeing these ads where it's like, retire comfortably with 500K. And I'm like, bullshit. No, you can't do that in today's environment. And I've noticed over the past couple of months, I haven't really seen those ads as much, but this was a survey recently where investors say they need 3 million or more to retire with ease. And they asked people, how much do you think you need to retire with? And they asked people in the US and Canada, Asia, Australia, Europe, Middle East, South America, and Africa. And in the US and Canada, the lion's share of people think you need either 3 or 5 million, which I kind of agree with that. But Miss Nikki CFP, I wanted to get your opinion on this. And we can also talk about some of the charts you pulled up with, the consumer and earnings. But what do you guys think is a reasonable amount that someone would need to have as a goal to actually retire comfortably?
I mean, impossible to answer with all the variables that go into retirement for people. But I mean, and when I talk about variables, I'm talking about, okay, do you have a house that's paid off? Do you have Social Security? Do you have a pension of any kind, or annuities or any other kind of fixed income streams coming in? So, depending on how much cash you need in the brokerage, right, will depend on those things too. So I know people that have much less than 500,000, but they've got Social Security and pensions that are covering their fixed expenses, so they can do it. And they have a house paid off, so they can get by, right? But yeah, I mean, generally speaking, if you want to have, it also depends on what's comfortable to you. I know for me, and probably for speaking for all of us, what's comfortable to us is probably definitely 3-5 million plus, right? So but I think that 1 to 3 million is probably going to be more so for most people. If they're investing for a very long time, they can accumulate. It's not as hard to accumulate $1 million in assets in retirement as you think. If you start in your 30s, even if you start in your late 30s or early 40s, you just have to really be diligent about contributions. But the earlier you start, the easier it is to get to that million. And a lot of people feel like it's not able to be done, but it is.
And I think that's why we do what we do, right? Is like, we obviously love trading and investing. We're in it all day, every day. But for me, at least, just the idea of like getting people to start, you're never too young, you're never too early. And I guess most people aren't too late, right? But even like you said, if you're in your late 20s or somewhere into your 30s, like, you can still get the cash machine going and compounding. And
You can. I think it takes based on historical returns, I think it takes $500 a month invested for 30 years at 7%, adjusting for inflation. Then you can get there. But you got to think about all the things that could happen between now and then, right? Is our stock market returns going to be what they were historically? We don't know. They could be lower. So if that's the case, throw more money in and you have to invest more money. So it's getting a little bit harder. But I'm talking to a lot of people that are retired or approaching retirement right now, oddly enough, and they're struggling. They're having a hard time. And
where are they feeling the squeeze, or what are the biggest issues you're seeing?
a lot of people, I do a lot of pro bono work too, and a lot of people that I talk to, they're taking on credit card debt in retirement or as they approach retirement, and credit card balances are up significantly. I think they're at historic highs, credit card debt, involving debt, but they're having to go there right now because inflation is pinching people. And so yeah, you probably are going to need to shoot for that 3 to 5 million, or try if you can, but most people aren't going to be able to accomplish that. And people are having a hard enough time right now doing things like paying for childcare and paying for their everyday expenses. So I've talked about the strong consumer before, but I'm starting to feel like the consumer is not strong. The consumer is just maybe more resilient than strong. But yeah, people really, 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 if you are in a situation right now where you have the luxury of thinking about what you're putting into investing in retirement and trying to get to that, whatever that goal is, 1 million, 3 million, 5 million, depending on what you need. Now with this changing environment is really a time to look at your plan and say, am I going to get there with this, or do I need to tweak something to get to put more money into investing? So a lot of people are feeling the pinch. Not to get all sad on everybody, but I mean, it's true.
Yeah. Well said. I think, just taking a look at credit card balances, all-time highs. And I know you've also got a few different things you're looking at here with income. What were you looking at here?
Well, I pulled up the real adjusted for inflation data. This is month over month data, but basically what I'm seeing is the personal savings rate is, I believe, if it's not at or it's below pre-pandemic levels, which
Mhm.
it could definitely be a little better there, but that's to be expected with inflation biting people. But when you look at like real disposable income is what we take and spend in the economy. And month over month, it just kind of looks like we're surviving. It's just stable. Year over year since 2022 or 2021 was such a crazy year with stimulus, it looks bad, right? Not only does that look bad, but hourly earnings, real hourly earnings. So when you adjust for inflation, we're kind of just chugging along, and compared to last year, we're down. We're not doing great. So savings rates, disposable income, those are things that I pay a lot of attention to because that's going to dictate what happens in the economy. And I wouldn't say the picture is super bad considering, but I will say it's not great either. I think inflation coming down will be a huge boon for a lot of Americans. That's really the thing right now is inflation. And I get why the Fed is so aggressive about wanting to decrease it and have it go down because it really is killing people financially.
Yeah. Well said. Trav, anything to add?
I do think the credit card data can be a little bit misleading. Anytime you look at overall debt outstanding in terms of the nominal figures, it can be very misleading because we're almost always hitting record highs. Like every year, every 2 years, you're hitting record highs, and you'll see articles written, you'll see people go on YouTube and freak others out and say, oh, this is the impending crash we've been waiting for 30 years. It's the next Great Depression. Well, the reality is nominal balances grow because the population grows, because GDP grows. So I think you have to look at these numbers as a percentage of GDP or as a percentage of household balance sheets, things like that. So you want to use those figures to really get a better sense of what's actually happening. And certainly, like you did show some of those rates, Nikki, of the savings rate coming down. It was super, super elevated during the pandemic. So we knew it was going to come down, but it's continued to come down. So even on a rate basis, yes, like the savings rate is coming down. And so I think that does align with what we talked about earlier with some potential for higher recessionary risks out there as we go later into the year. And so I think that's real, but I don't think when you look at like household debt as a percentage of GDP and things like that, we're not at like all-time highs or at alarming levels like we saw like in the prior to the GFC. And so it's important to have that context too. When you hear other people out there showing these figures in nominal figures and crying that this is the next Great Depression about to hit, slow your roll on that. I'm not, I'm not ready to say that we're headed for another GFC because credit card balances are at their all-time high nominal levels. We're not so bad off when you look at things like levels as a percentage of GDP or as a percentage of assets. So just wanted to have that context in there as well.
I agree with you 100%.
But fear sells, man.
No, that's an
right.
important
It does.
point because even when you look at like mortgage debt as a percentage of disposable income or credit card debts as a percentage of disposable income, and that is key too to look at, and it's actually below pre-pandemic levels. So I think that's why it's so confusing to kind of parse out right now how the consumer really is. But I will say anecdotally from the people that I've talked to in the lower income category, and of course this is known, right? People feel it worse in that category and they are feeling it. And I'm just really more concerned about that than anything. We'll be okay. Like we can survive, but it's the lower income individuals that are just really struggling with this damn inflation.
Yeah, I mean, a lot to think about there. I know, everybody's looking at the charts right now, trying to figure out what's going to go on. We're mid-range. We've got a mixed bag, macro, fundamentals, even earnings, right? Let's talk a little bit about earnings. I think that's coming to a slowdown. Like what were the big takeaways from this season?
Well, I guess to kind of piggyback off of what we were just talking about with the consumer, I think Walmart and Home Depot earnings kind of told an interesting story. Walmart actually, a lot of people have shifted to Walmart. They're capturing more higher income consumers. Again, going back to us being more conscious about spending now. And actual revenue, top line revenue, is growing fabulously at Walmart. But bottom line, they are seeing some declines there, and that's concerning margins, basically. But generally speaking, I thought that the Walmart report was, Walmart's kind of like a stable coin right now, the way I'm thinking about it. Home Depot, though, Home Depot's increasing the dividend, and I'm pretty sure, Trav, I don't know if you looked at it, but correct me if I'm wrong. I'm pretty sure they're still doing okay in terms of margins. Guidance wasn't great. But yeah, I think that obviously the housing market is taking a hit, and what's gonna Home Depot will probably chug along, but it doesn't look too exciting for them, at least over the next probably year or so. But
Yeah, they did call out that they're starting to see some weakening in some of the remodeling activity, which was what helped them as the housing market really weakened last year. Remodeling picked up somewhat, particularly among the pro side. There's a lot of jobs that people were still catching up on, but they are really starting to see some weakness in the consumer side of the remodeling. So people taking on things like kitchen or bathroom remodeling, that's being pushed aside. Now, if you have things like roofing, which are more necessity based, that's still doing pretty well, they said. But overall, they are seeing, particularly among non-pros, a pullback in spending on remodel activity. So that certainly factored into their guidance for this year. It does look a little bit weak right now. They're kind of looking at how things are performing out there and saying, I don't know about 2023. It doesn't look like it's going to be super great. Now, that being said, Home Depot has always been a powerhouse and through most cycles has continued to grow its earnings per share. So, it's one of those companies that's done quite well, but could be in a tough position for a little bit of time, particularly if we get a worse economic outcome this year. But overall, for earnings season, what we've seen with, I think, about 85% of the S&P 500 now having reported their Q4 earnings, we saw that earnings growth overall was down year over year. So I think negative 4.7% growth in earnings for the fourth quarter. And it's a little bit worse than that if you exclude the energy sector, which had a very positive contribution to earnings growth. So that is the first time we've seen earnings decline since the middle of 2020. And that doesn't bode well if that trend continues. Analysts have forecasted that earnings will start to improve by the third quarter of this year. Again, that's a risk because if they don't, if we actually see it get worse, if the declines in Q2 and Q3 start to get worse because we are entering a recession or unemployment's ticking up, then the equity markets are definitely going to look expensive here at these levels. And so that's why I think we have started to see some concerns start to rise and equity start to pull back this past week. So yeah, I mean, earnings were good for some companies, but overall not super great from what we saw. And guidance wasn't very good on average either. So that's definitely a concern for stocks here as we go further into the year.
And then as far as the rest of the week goes, we've actually got a pretty stacked calendar. We got jobless claims tomorrow, GDP growth rate, but on Friday we've got personal income, spending, and new home sales. So I know a lot of eyeballs are going to be on that. And then I think, pending next week. But it's been a really volatile week. A lot of people are just confused right now. There's a lot of mixed signals out there. And so that's why, look, I think long-term and short-term, right? Long-term, we're, Bitcoin's well off of its highs. I'm starting to stack some coin. I'm interested in trading alts, but I'm being patient and not getting overly aggressive. I think, like you guys said, bonds are getting more and more attractive. And so that could suck liquidity away from the equities markets back into a quote unquote more safe, stable situation. I don't know, any other theses?
A lot of people are asking that question right now. And I actually did a video on this on my YouTube and posted it last week because a lot of people are asking, like, what do I do right now? Do I buy the stock market or do I wait for the stock market to crash? And like, I know that in this episode, I kind of sounded a little bit of a Debbie Downer, but I think that's more of a reflection of like some of the stories and people I've been talking to recently. It's been kind of heavy stuff. But generally speaking, the data is very mixed, right? There is still a lot of good and a lot of bad all around for the consumer and how we're doing generally. And so it's just, it is a confusing time, but I guess that was going to be my question to you guys to kind of roundtable it is, how can people, or how do you think people should be approaching that question right now of buying stocks or not, or buying Bitcoin or not, or, what is the general advice that we can give people if they're feeling confusion about that? Because I know a lot of people are.
War game it. Think about the possibilities, right? Like, what is the worst case? Like, say Bitcoin goes down another 50%, right? What does that look like? How are you prepared to respond to that? Or if we break 25K and we go back into a bull market, how are you prepared to respond to that? Obviously, like on the higher level, like portfolio side, Nikki, that's, I think, where you can help a lot of people is looking at their situation. And like you say, I mean, there's no one right answer for anybody. There's so many variables, especially when it comes to investing and goals. And, but Trev, how do you think about it? Just looking at everything from kind of your perspective of being the fundamental guy and really thinking deeply about valuations.
Yeah, I think it's, like Nikki said, really hard to figure out a strong stance because we have a lot of mixed data. The market's not at super expensive or super cheap levels. There's a whole big debate raging about inflation versus deflation. Are we needing to go higher because inflation is going to remain hot, or are we about to hit a recessionary path and rates are going to come down? And it does make it really difficult. So for me right now, I mean, I said earlier, buy bonds and go to the beach. I think that actually is kind of enticing, like not doing a whole lot and letting your cash sit in 1 or 2 year treasuries and earn 4.7 to 5% and just kind of wait to see how things develop is an okay strategy. Now, again, I still am going to own some stocks, but I might shift part of the portfolio into that and be less aggressive and kind of wait. I know, Chris, you've had that stance before as well during parts of the crypto cycle where there's just times where there's not a lot to do and maybe you don't want to take action because it's not as clear. So yeah. I think it's a good time to maybe sit on the sidelines or just be less active, let the excess cash sit in short bills or bonds earning 4.7 to 5% and kind of wait it out and see how it plays out. I don't think that's a bad strategy right now.
Yeah, I think now is a dangerous time for people because people get lazy and bored and disconnected, right? I think now is a time to prepare, to sharpen your skills, to hone your strategies, think about, like we said, all the possibilities and probabilities and the outcomes and what would cause you to respond or take action, right? Even if we're not in an environment where it's like, yes, take every trade you see or stay away from every trade you see. It's one of those kind of in-between points. I think it just makes sense that the worst thing to do is to get bored and disconnected from the markets. And this is what we see every market cycle is a lot of people in the bear markets will leave and they'll go about their day, the easy money they think is over, and then they'll come back late into a bull cycle where the gains have already been there. So you have to, if you want to make a lot of money, you have to sit through the boring times. But that I'm grateful for the boring times because that's when things are less noisy and you can actually have time to prepare and research and do the work that you need to do and plant the seeds you need to plant so you can harvest during the bull cycles.
1,000%.
Yeah, that's a great point. Yeah. Do the research work. Yeah. Stay on top of where the market's going, because like you said, like you'll be too late and you'll miss the early parts of the cycles when things do turn and become more clear.
Yep.
Yeah. And I have a feeling when things turn in this market, it's going to turn much faster than probably historically it's turned. I feel like there's been a lot more warning before, but this market seems to be moving a bit quicker. It's a bit faster paced. So this could easily be a market that if you're not paying attention and you're off at the beach too long with your bonds, maybe you could miss something. So that's an important point.
And with that said, if you want to get prepared and you want to be in the markets with us every day, go to wetalkmoney.com/community. Check out the wealth building community. We do live classes every week, watch lists, alerts, deep analysis. We do money mindset meetups. We do all kinds of fun stuff, and we're adding things as the months go by. So if you're sitting there trading or investing on your own, or you just want to get engaged with a community of like-minded people, go to wetalkmoney.com/community. And we still have the promo code up, I believe, right, Nikki?
Yes. Build wealth.
Build
All
wealth.
one word.
Get your first month or quarter half off and see what it's all about. And we'd love to have you there.
That's right.
Yeah. Awesome. All right. Any final thoughts? Anything you guys want to wrap up with? I did my little tangent. I'm going to kick the floor to you.
I'm going to kick it to Trav.
Let's play hot potato with the mic here.
Well, let's see. We've got NVIDIA reporting earnings after the close today. I'll be tuning in for that. A little scared to see what happens there. Should be an interesting one.
Are you
AI, it's going to take all our jobs. So we got to tune in.
None of this matters
NVIDIA.
Anyway.
Yeah, so we got to tune in to find out what NVIDIA has to say about that. Other than that, yeah, we'll be continuing to just keep tabs on the market. I mean, natural gas and crude, a lot of action happening there too. So I'll be looking at energy stocks in the next few weeks to see if there's any opportunities there. Nat gas down like 80% in the past 6 months. Kind of crazy. I think it's sort of flown under the radar, but yeah, beyond that,
that's been a weird one. What's causing that to dip so hard?
Well, yeah, I mean, it's been a relatively warm winter in Europe and the US. And then you've had, the shutdown of Freeport. So we weren't exporting as much gas as we could and things like that. So there's been some microstructure stuff as well as some macro related things. But I don't think we're out of the woods forever on the supply demand imbalances that we saw in crude and nat. But yeah, we'll have to take a closer look at some of the stuff happening there. The energy stocks still look super, super cheap if you believe that, prices come back a little bit. So we'll see what happens there. Definitely doing some work in that sector. But yeah, other than that, it's a relatively quiet week after NVIDIA reports. We've got a big March coming. March is going to be full of stuff from the Fed meeting. We've got jobs reports, CPI reports. You've got, lots of stuff happening around politically, what's happening in debt ceiling fights, stuff like that. So March and April are going to be quite active and interesting, but maybe a little bit slower here in the next week or two leading into that. So good time to do some research work.
Mm-hmm.
Cool. All right, guys. Well, thanks for tuning in, and we'll see you in the Discord group and in the live classes. Otherwise, have a great week, and we will see you next week. Take care, guys.
Cheers.